working, lived in Richmond, Virginia, working in public accounting, and read an ad in the Wall Street Journal. Richard Dennis, the famous commodities trader, wanted to hire people and train them how to trade. And so I ended up getting the job.
And so you applied off you responded to basically an ad.
I responded to an ad. I don't think I ever really looked at the Wall Street Journal 1 ads a lot, and, but I had been sort of formulating my own trading strategies by basically watching TV, reading books. I guess my early mentor or early kind of inspiration was Marty Zweig, sort of a trend follower, a contrary opinion type person. And so when I got the interview, and there was a test involved also, so I got the test and the interview, I was sort of ready.
And when did you first know you liked trading? Like, how old were you?
It was early on. I thought that trading was a pretty good idea. And then somehow, and of course, in their 20s and in the 80s, maybe sort of even now, it's sort of about stocks, and the stocks are everything. But I say that sarcastically. So, but then I guess somehow, even before that, I heard about commodities and futures, currencies, interest rates. And even as a 20-year-old, my mind was totally open. I was thinking, yeah, that's a pretty good idea. I mean, long, short, I like that. Diversification, that's got to be good. So I was ready for my opportunity.
And so, Richard Dennis, tell us about what you did as a turtle trader, because and just dive in a little bit about that.
So we get there in
where was it
in Chicago. So I left Richmond, and I had a suitcase, sold my car, sold my microwave. I might have 2 suitcases. And so I went to Chicago, and we had a 2-week course on how to trade. And then January '84, we started trading with his money.
How much?
$1 million.
Each?
Yes.
A lot of money in '84.
It's a lot. And we each had $1 million, and we were...
And what was the deal? You could keep some of it, or?
15% of the profits. Small salary, 15% of the profits. And the overriding rule was just follow the system. If you make money doing the wrong things, then you'll probably be fired. If you lose money and you're doing the things we taught you to do, then no problem.
So like a prop shop, but one of the first of its kind?
I guess. I'm not sure what that is, but
okay.
We were sort of told that if you lose, if you're down 50%, you're going to be called in and talked to. And if you're down 60, you'll be fired. So after 3 or 4
That's
months,
a lot of wiggle room. The 50% out, so they wouldn't stand over you and you were left alone.
We were definitely left alone. It was definitely a sink or swim. But after 3 or 4 months, everyone was down to 50.
Every single person?
Pretty much.
Wow.
And so then they called, they were sort of famous for anytime they wanted some communication, it had to be one sentence or less. We had to write 1 sentence. And the sentence was, should we fire you guys? Should we keep everything the same? Should we, or give you more money? And so basically they gave us more money. And that was sort of the low, and we ended up making lots of money that year. And basically we averaged about 200% a year.
As a group or?
Each individual.
Wow. And so what was the end game? You get to keep 15% of that, so you have a little money in your pocket. And what markets were you trading to get those 200% gains?
Well, right now we trade 100 in some markets and 100 stocks, let's say, so 200 markets. But back then it was maybe 20. But a few currencies, a few commodities, interest rates, and stock indices.
And so the model felt that you could train that quickly?
Supposedly the deal that they had a bet going that trading could be taught or trading couldn't be taught. So definitely this style, I think, was definitely teachable.
And so do you believe it now, flash forward 32 years, is it teachable or is it, or we further, like, is it born or is it taught? And can you do it would you do the same thing with your money as they did with theirs?
It's definitely teachable, but I don't think there's very many people who are willing to be taught. and stick by the rules in a strict sense. We do everything pretty much the same way, basically, that we did in 1983 and 84. And the training, except we're longer term. I think the shorter term trend following, you just get chopped around. But now I think the new turtle class, or new sort of turtle, if you were to do a new turtle class, it would be something, it would be mostly coders. So Richard Dennis, using his experience and his knowledge of the pits and trading, and with his computers and with his back testing, and just telling us how to do things, it's kind of like, doesn't make a lot of sense. I think now if you wanted to be part of a program or hire people, you would say, I want to hire some people who can code, who know something about math, and who kind of know how to win a game. And because
it should be the perfect generation.
Yeah, it should all be systematized and no discretion. And I think this is sort of where the world is headed. For some reason, we as a society sort of adopt Watson and chess, and everything can be systematized except managing money. I don't really want my money managed by people who just follow a computer. And so eventually that'll give way to everything will be systematized. And I think to some degree, the arguments or discussion about active versus passive is really just systems versus non-systems. The S&P is a system, it's a poor system. And of course, very few people can beat it who use more or less discretion. So I think maybe people don't really understand that at this point, but eventually it'll be unusual to find somebody who, or find people who will sort of think that, somebody who has discretion and just seat of the pants style of trading is someone I want to manage my money.
But with the S&P as a system, you obviously have your own system or your own beliefs of how money is managed. So when you wake up every day, how do you think about your system?
Well, first of all, I think about it needs to be very, very safe. And so I think that every day...
Is that because you're wired that way, or...?
Well, I'm an accountant, at heart. So yes, sort of, but I know better. So maximum diversification, currencies, commodities, stocks, interest rates, long and short, and sort of all sort of in gear with the trend. I think trend following is very similar to an indexed product, but with better rules and maybe non-random rebalancing. So we sort of like just try to put it in those terms. I think we're taking advantage of all this diversification, but choosing the long or the short and the position size based upon things that are not sort of random, like let's rebalance at the end of every year or something like that.
So in '88, you go start on your own. What was it like raising money?
It was very easy because it was a different era and people were greedy and we were making lots of money.
Were you getting lots of press, you mean, or he probably didn't want to keep you to himself,
in 1983, I traded for Richard Dennis from 84 through 87. And so 88, I started Chesapeake. And so then I just would talk to people on Wall Street, and there were managed futures departments at most of the big wirehouses. And we started making money, and people would just throw money at you. Because frankly, the fees that they were making off of those accounts were way too high.
So how big did Chesapeake get?
$2 billion.
So you were managing how many people would be part of $2 billion?
50.
So 50 people, and where were the offices out of?
Richmond.
Okay, so Richmond, Virginia. So it's $2 billion. What's the worst position at that size that ever happened? What can you remember?
I can kind of remember. I think, let's back up to 1986 with Richard Dennis. We were making, like I said, averaging about 200% a year.
There's a little volatility.
Yeah. So I lost 60% in one day.
Were you long Alibaba? Oh, sorry, that was the wrong time.
I was mostly just a huge leverage
Was
position.
it on a China worry?
It was
just huge
being
level.
short energy in 1986. Crude was going down to $10. We just had massive positions on it, and we just had a nice counter trade day. And so I went home that Friday, and I had $1 million bonus. This was in '86, so I was really, really happy. And then Monday morning, I ended Monday still up 140%. But I would say that the biggest issue we had in Chesapeake was probably 2007.
Meaning the big drawdowns come after big gains.
Yeah, sorry. So that's one of the benefits of trend following, and I think over the past 10 or 15 years, trend following has sort of, not a lot of people sort of practice real trend following because it's basically cut your losses short and let your profits run. And so when CTA started raising lots of money in sort of institutions, they become more concerned with the drawdown and vol targeting and reducing your risk in your position when the volatility gets high. So even if you have a huge monster profit, we bought gold at 800 and it goes to 1900, that's a huge profit, so don't do anything. Well, not so quick. Some of the competitors and traders, they feel compelled to reduce that position and sort of put it in line with the current volatility versus the original volatility. So the drawdowns can be really large if you don't do that.
And so today, what same company, Chesapeake, how many people are at Chesapeake today?
Probably like 15.
And what's different today? Like what's different today about the way you look at things versus at the peak at $2 billion?
Well, I think as Cole from Longboard was saying, it's for most U.S. CTAs, I would say, it's mostly a mutual fund game now. So you can kind of put the same CTA program inside of a mutual fund, a liquid alt, and that's sort of the best way for at least the U.S. CTAs to raise money. AQR has $9 billion, Campbell over $1 billion. It's pretty much their same trend following, systematic, lots of diversification program. Whereas a lot of the European CTAs are still able to charge an incentive fee and still not have to worry too much with the mutual fund business. So it's kind of a come down from $2 billion at 1 in 20 or 2 in 20 to mutual fund business where potentially, hypothetically, we could raise a lot more money, but maybe no incentive fee.
I want to open it up to some questions. We'd like to talk forever, and some people here. We have Bruni here. You're 19 years old. You love the business. Anything you'd like to ask Jared? Don't worry, I don't want to put the pressure on you, but Bruni is a lot of people in the room. Does anybody wants to ask a question of Jared? Yep.
I was told that commercial trading position size risk got out of control. What type of percentage position size risk were you doing that? What type of percentage risk are you doing now?
Yeah, so it's a question about the risk in the 80s and with Richard Dennis and the risk now. So none of the turtles really blew up. I mean, I think Richard Dennis, after the turtle program, had some issues with some of his trading, but it was very aggressive. So I would say that back then we would risk about 2% per trade. And so we sort of lucked out by not blowing up, I would say. And the markets were different. This trading strategy was much shorter term and different. So we would risk 2% per trade. So, and it was even worse than that. If the market went 2 average true wages against us, we would lose 2%. So we were frequently losing 2% and then getting right back in. And then if crude, heat, oil, and lead it all hit at the same time, basically, we risked 6%. So now we risk about 10 to 20 basis points.
It's that much tighter.
Yeah. So I remember my first, even when I left, even when I started on my own, 1988, I sort of knew enough to sort of think, yeah, 200% is a little bit too aggressive for these clients, maybe I should shoot for 20%. And so now we're sort of targeting return involved is about 15%. Yeah, you had a question? Well, you know, it's a lot of the terminal trading is on the internet, and I would say that the terminal trading money management is the best. Cannot get any better. If it could, I would have changed. So the way we do the money management and the trade sizing and things is pretty darn good. I really haven't tweaked that too much, but the biggest, like I said earlier, the biggest change has just been to be longer term. You need to use 200, 300, 400-day moving averages, let's say, versus back in the day it was maybe 50-day moving average. It's just too short term. The markets are choppy. There's a lot of trend followers. There's a lot of computers out there. And so basically you can still have really nice trends. There's been a lot of great trends over the past 3 years, but you can't keep getting knocked out only to have to get right back in. So you've got to figure out, okay, I need to trade long-term enough where I don't keep getting bounced out. So that could be like a 300 or 250-day moving average. But then some of the give-backs could be pretty tremendous. So you've got to sort of figure this out for yourself. Is how am I going to stay in the long-term trend in energy and stocks and dollar, the bonds, and yet when it kind of reverses, I don't want to give back 2/3 of my profit before it hits my exit. So I think I have talked to so many traders, and I have hundreds of Google alerts, and so we're always trying to keep up with everybody and what's going on, and talking to traders and investing in traders, and visiting them, and chatting and arguing and debating. So I'm putting myself out there to all willing to change my mind and to alter, but I haven't really changed that much.
Do you think social is like the biggest change to the industry? The fact that people are just talking to each other more, or no? You like it, you use it. Mm-hmm. And so,
I don't think any of the hedge funds or CTAs or have figured a way to monetize or help their business with the...
no, just communication, I mean.
Yeah.
The question over here.
You mentioned AQR. Take a look at trend following behavior from the momentum investor. You see the same thing.
Oh, it's a fantastic question. I got into this...
Is trend following the same as momentum investing?
Sorry. Yeah, I got into this debate with Cliff Asness on Twitter. Very short debate because I knew that I didn't want to get into a full-fledged debate. I know my limitations. And so it's quite a bit different in the sense that momentum, the way I understand it, is I don't like it that much because it's basically you have a universe of 200 stocks, let's say, so you're long 100 of the strongest in the past 12 months, and then you short the weakest, the lowest returns over the past 12 months. So I don't like it in the sense that I don't think it's a good idea to base your entries and exits on other markets. So you may be long Microsoft in this strategy, but if your universe was slightly different, you may be short Microsoft. So that never really, this doesn't sit well with me. And the momentum stock people have had issues with their 100 longs and 100 shorts in periods like 2008 when everything gets trashed and the longs can have a tendency from a momentum and trend following point of view to go down harder than the shorts might even rally.